sector. The sector, of course, has reported a mixed performance in the third quarter. So what lies ahead, and are these green shoots of demand really blossoming into full plants and maybe even trees later down the line? We have with us Kawaljeet Saluja, who's Senior Executive Director and Head of Research at Kotak Institutional Equities. And, of course, he's joining us from the sidelines of the KIE Chasing Growth Conference. Kawaljeet, thanks so much for joining in. You know, in a market that's beaten down so badly and confidence is so low, we keep looking out to tech as some island of safety. But beyond that, that's a tactical positioning point of view. I mean, I want to start with the real growth question and what stood out for you. Before we talk about large caps, actually, let's talk about the tier 2 companies, whether, any of them really fired up your imagination.
Well, I think, what's been happening in the sector is essentially a gradual recovery. What you're going to get, in our view, in FY26 is a growth rate which will be better than FY 2025, but it will still not hit the normalized level of growth. And the reason is because the growth recovery is patchy. There are segments in the market that are doing well, which is financial services and retail. And at the same time, there is deterioration in the manufacturing vertical. Now, within this spectrum, what is happening is that some of the challengers are doing better than some of the incumbents, especially the likes of Coforge and Persistent, which seem to be firing, all guns and actually would end up reporting growth rates which will be materially better than the peers. Again, having said that, not all challenges are the same. Not all incumbents are the same. There are basically a mixed bag of performers in both the segments of the market.
Okay. We'll come to the mixed performance in a bit. But now at a headline level, now I'm talking about the traditional IT services companies, the big boys. There, Kawaljeet, what are the different trends that are emerging? Most of them, I remember the commentary, you were talking about sort of cautious optimism and seeing some improvement in demand in North America. So for FY26, what's the kind of growth in the business that you're penciling in?
I mean, essentially, it's a recovery. It's a very gradual recovery. It's a frustrating recovery as well. So let's say if you're penciling, if these companies would have grown by around, on an average, 4 to 4.5% in FY 2025, then at best you can pencil in 6.5 to 7% growth in FY 2026. Again, there'll be dispersion in growth rates depending on a couple of factors. One is the large deals and mega deals. I mean, there are not many of those. And second is the contribution of revenues from verticals that are in a state of recovery versus verticals that are in a state of challenge. So FY26, again, at a broader level, there will be some improvement. But within that, the dispersion in growth rates will again be there, as you saw in FY25.
All right. Hi, Kawaljeet. Nigel on this side. And good to have you on the show after a while. You know, the argument is that global IT peers, where you look at Cognizant, you look at Accenture, they're trading at relatively cheaper multiples in comparison to what our Indian companies trade at. Could you tell us your comment on that? Justified? How does it shape up?
Accenture, I think the valuations have almost converged with Infy and TCS. Cognizant, you cannot compare on valuation because the growth rates are lower and the company is in a turnaround phase. So, so to that extent, there are not enough number of global services companies for comparison. But when it comes to specific, it's just the factors that I just laid out.
Right. You spoke about valuations converging with TCS and Infosys for some of these companies. But TCS, which is up only 3% in the last 3 years, has been an underperformer. It's one of your top picks. And you do acknowledge that, it'll be difficult for the company to backfill the loss of revenue from the BSNL deal in FY26. What makes you still bullish on TCS?
The BSNL deal does not change the EPS, right? It's a zero margin deal. So the only thing is that the top line becomes lighter, the margins go up, your EPS growth will still be around 9 to 10%, yeah. So think about BSNL as empty calories for now, yeah.
Okay.
Empty calories, okay. Usually we try and avoid them, but then again. So, to go back to the point, and I'm just simply asking from a, portfolio positioning point of view, are you better off, if someone has to allocate fresh capital to Indian IT, are you better off being with the safety of the likes of TCS or Infosys? Or should you look at, Coforge and Persistent, the companies that have been showing growth? Or should you go to the third leg, which is some of these ER&D companies like KPIT Tech, Tata Elxsi? They've had a bit of a rough ride last few quarters. Do you see that, also recovering? Where to put the money in IT?
Okay, so I'll give you a boring answer. First of all, for the time being, avoid engineering services because there are headwinds in engineering services across multiple segments, whether in autos, whether it's in high tech, etc. So I would avoid engineering services. When it comes to between the incumbents and challengers, there has to be some fun, right? And there has to be what I would say, some sugar as well, rush as well in names like Persistent and Coforge. So you end up buying, I will recommend Coforge because the growth will be turbocharged, far, far better than what basically the street is building in. 20% plus organic growth in FY 2026. The stock has come off, so we'd recommend Coforge. And Infi and TCS, one can basically pick any of them at the current levels. I'll just say that Infosys nudges ahead purely because they have a higher discretionary exposure, and the base assumption is that in FY26 discretionary spending will recover. Then maybe the growth rates will end up being better in Infosys. So Infosys, Coforge, you pick one. From each category.
Kawaljeet, you're really whetting our appetite this morning,
huh? If you want to have a wider portfolio.
Yes, go on. I'm saying you were really whetting our appetite with the empty calories and a little bit of sugar rush with Coforge and then Infosys. But please complete the point. You're saying maybe Infosys can edge ahead on the growth. But please complete.
No, but if you want to basically have a well-balanced, rounded portfolio, have Infi, have TCS, have Coforge. There's a turnaround play in the form of TechM, which seems to be forgotten. So there are plenty of options to look at in IT services here.
Okay, right. but no ER&D. We remember that point as well because engineering in some of those sectors like autos still perhaps the recovery is still some time away.
We have some, absolutely. Some good companies, but unfortunately the macro environment is fairly challenging for them. But there's some very good companies in the space over there.
Thank you so much for joining in. The basic idea is a balanced diet and a balanced portfolio. Use the macros right with Infosys, TCS, and TechM, maybe a bit of sugar rush in terms of Coforge as well, but no more than that. Thank you for joining in and wish you a good conference as well. With that.